Welcome to the Opening Bell Report.
If you're holding Netflix stock right now, you're probably not having a great morning.
Not at all.
The stock's hovering around, $75.86. It's down roughly 30% from its highs. I was looking at the chart before we started, and it's ugly.
It definitely looks like a panic sale out there. You just see red everywhere.
And if you just read the headlines, you'd assume the company's in like a death spiral.
Mm-hmm.
But then I opened this new analysis report we're looking at today. It's titled Netflix 2026 Operational Mastery Amid Strategic Expansion. And honestly, it feels like gaslighting.
How so?
Because the company in this report, record profits, exploding margins, it sounds like a completely different beast than the one the market is dumping.
And that's the disconnect we really have to dig into.
Yeah.
This report frames it as a tale of two realities.
Right.
You've got the market reality, which is all fear, uncertainty, a lot of skepticism. But then you have the operational reality. And if you just look at the numbers, the business has arguably never been healthier.
That's the conflict I want to resolve today. Because Netflix just posted its best financial year ever, yet the market is treating it like a distressed asset. So is the market just wrong?
Well, it's not so much that something is lurking in the shadows, but it's about what's right in front of us that people are interpreting, well, completely differently.
It's a classic numbers versus narrative story.
Exactly.
Well, let's start with the numbers, because the report calls this the scale era. And they compare where we are now in 2025 to just a few years ago in 2022, which they call the growth era. And the difference, it is startling.
It is. I mean, if you go back to 2022, operating margins were around 18%.
Which is a decent business.
Very good business.
Yeah.
But last year, they hit a record 29.4%. That is a massive leap in efficiency for a company this mature.
But the number I think people actually care about, the money you can put in your pocket, that's free cash flow.
Always. You can't buy back stock with operating income. You need cash.
Right. So in 2022, their free cash flow margin was like a measly 5%. In 2025, it hit roughly 21%. That is a 320% increase. How does a company that's already massive get that much more efficient that fast? Did they just stop spending money?
No, and that's the fascinating part. They didn't slash the budget. This is a textbook example of operating leverage.
Okay, stop there. Operating leverage is one of those MBA terms that gets thrown around. What does it actually mean for a streaming company?
Okay, think of it this way. If you run a coffee shop and you want to sell twice as much coffee, you have to buy twice as many beans, right?
Right, and probably hire more baristas. Your costs go up.
Exactly. Your costs scale with your revenue. But Netflix is now fundamentally a fixed cost business. The report highlights this one crucial stat: cash content spend.
Their budget for shows and movies.
Yep. In 2022, Netflix spent about $17 billion on content. In 2025, they still spent about $17 billion.
So the cost to run the factory stayed flat?
Flat. But the revenue, the money coming in, ballooned to over $45 billion. So once you cover that fixed $17 billion, almost every extra dollar of revenue just drops straight to the bottom line.
That's operating leverage. It's the difference between selling coffee and selling software.
Precisely. And now they've added a whole new layer to this with the ad tier.
Which I know a lot of people were skeptical about. I remember the big worry was that it would cannibalize their premium subscribers.
And instead, it became a profit multiplier. Ad revenue grew 2.5 times over in 2025. But the key here is incremental margin.
Meaning what?
Meaning, once you've built the technology to serve ads, the servers, the sales team, that cost is sunk. It's paid for.
Okay.
So when Ford or Coke pays $1 million for a campaign, Netflix doesn't have to make anything new. There are no shipping costs. It is almost 100% pure profit.
So you have flat content costs plus a new revenue stream that's almost all profit. That explains the cash flow explosion.
Exactly. The cash burn days of the streaming wars are, for them, historically over.
Okay, so the engine is efficient. I get that. But efficiency only gets you so far. You need growth. And this is where I get nervous, because back in 2022, the whole narrative was Netflix is saturated.
The saturation myth.
Yeah. So where is this new growth coming from? Are they just raising prices on everyone? Because that feels like a short-term trick.
Price hikes are part of it, sure. But the 2025 numbers show something much more robust. Revenue growth is actually accelerating.
Accelerating.
Yeah. In Q4 of 2024, growth was 12.5%. In Q4 of 2025, it jumped to 17.6%.
That's a pretty big jump.
And the report emphasizes that this is high-quality revenue. It's driven by higher ARPU, average revenue per user. And the big drivers there were the password sharing crackdown and the upsell to the ad tier.
Okay, but I have to play skeptic here. The password crackdown, that's a one-time event, right? You kick the freeloaders off, they sign up, you get a bump. But you can't do it again next year. Isn't this just a temporary sugar high?
That's a valid concern, and it's one of the reasons the stock has been so volatile. But you have to look at the relative performance.
Compared to who?
The report lines it up. Disney's streaming growth is at roughly 6%, Warner Bros.
Yeah.
Discovery, who we'll get to in a minute, is actually shrinking. Their revenue growth is -2%.
They're shrinking.
They are literally going backwards. So even if the crackdown was a one-time thing, it reset Netflix's baseline to a level where they are outpacing the entire industry by a factor of 3. They're the only ones acting like a tech growth stock.
While everyone else is acting like a struggling media company.
Right.
Which brings us to the part of this that makes absolutely no sense. If Netflix is the only one growing, the only one with these insane margins, and the only one printing cash, why is this stock down 30%? Why is the market so terrified?
Because of how they're choosing to use all that cash. We have to talk about the merger.
The $82 billion deal, the pending acquisition of Warner Bros. Discovery.
And the market absolutely hates it.
I mean, I look at the debt numbers in this report and I get a stomachache. To buy WBD, Netflix is taking on roughly $67 billion in new debt.
New debt. And that's not all.
Plus, they have to assume about $10 billion of WBD's existing debt.
It's a massive, massive leverage event.
It feels reckless. They finally cleaned up their balance sheet. They became this cash fortress. And now they're mortgaging the house to buy, what, a shrinking competitor?
That is the bear case in a nutshell. Investors see risk. They see interest payments eating up all that beautiful free cash flow. They see the end of share buybacks, which have been propping up the stock.
And it's not just the money, right? It's the mess. Merging media companies has such a terrible track record.
Oh, it's historically very difficult. You remember AOL Time Warner?
Of course. Or AT&T buying Time Warner. It's a nightmare. Culture clashes, integration problems. The market sees WBD as a falling knife. Why try to catch it when you're already winning?
Exactly. Why not just let them die and pick up the pieces? That's what the market is asking. But the report argues there's a strategic truth here, that the fear is blinding people to.
Okay, what's the truth?
Starts with the price. The report says they're paying about 7 times EBITDA.
Okay, for those of us who aren't investment bankers, what does that mean? Is that expensive?
Think of EBITDA as the raw earnings power of the business. Paying 7 times that number is, in the media world, incredibly cheap.
It's a distress price.
It's a bargain. A fixer-upper? Maybe. But look at the assets. You're not just buying a struggling streamer called Max. You are buying the entire HBO library. Warner Bros. Film Studio. Yeah. You're buying DC Comics Batman, Superman.
The IP.
The IP. And by doing this, Netflix effectively eliminates its biggest competitor for premium talent. If you own HBO, you don't have to bid against HBO for the next Game of Thrones. You just own it.
It stops the bidding wars.
It creates a content fortress. And here's the stat from the report that I think is the most important for the bull case.
Go on.
If this deal goes through, the combined Netflix WBD would command approximately 40% of all TV time in the United States.
40%? That is nearly half of all television consumption.
We haven't seen that kind of dominance since the peak of the big 3 networks.
The leverage that gives you with advertisers must be
unmatched. If you're Ford and you want to launch a product to American eyeballs, you have to go to Netflix. They can dictate pricing.
So the argument is, yes, the debt is scary, but the result is a monopoly that will generate so much cash the debt won't matter in a few years.
Correct. Now, the report does note some external drama blackness, and Cora Holdings is opposing the deal, and Paramount Skydance threw in a counterbid.
Is there a real risk Netflix loses to Paramount?
The report is pretty dismissive of that. It just comes down to cash. Netflix has $9.5 billion in free cash flow. Paramount has, well, basically none. In a bidding war, cash is the only ammo that matters.
And Netflix has the bigger gun.
By far.
Okay, so let's try to land the plane. We have a company with incredible operations, but this terrifying merger looming. The stock is at $75. Is it a trap or is it a steal?
Let's look at valuation. This is where the disconnect is most obvious. At $75.86, Netflix is trading at roughly 30 times its trailing earnings.
30 times. For context, is that high? Low.
For a bank, it's high. For Netflix, historically, it's very low. For the last decade, Netflix has rarely traded below 35 or 40 times earnings. Often it was at 50 or 60.
So relative to its own history, it's on sale.
Right. But I hear you, the growth is different now, so maybe that's not a fair comparison.
That's what I was thinking.
So let's use the PEG ratio, the price earnings to growth ratio. This is what investors use to see if you're overpaying for growth.
How does that work?
You take the PE ratio, which is about 30, and you divide it by the earnings growth rate.
Which is what?
About 31%. EPS jumped from $1.93 to $2.53. So 30 divided by 31 is
roughly 1.
Exactly. A PEG of 1.0 is considered fair value. For a company that is effectively a global monopoly in its field, finding a PEG of 1.0 is incredibly rare. The report calls it technically undervalued.
So the final conclusion is that the market is mispricing the company because it's just so fixated on the merger debt.
That's the verdict. The report wraps up by presenting 2 potential futures. Future number 1. The WBD deal closes. Netflix takes on the debt, absorbs HBO, and becomes, the the Disney of the 21st century.
And future number 2, the deal fails for some reason.
In that case, the debt fear vanishes overnight, and Netflix just goes back to being what it is today, a cash-rich machine with 29% margins that keeps buying back its own stock.
So in either of those scenarios, the report suggests a pretty strong floor at $75.
That's the argument. Whether they buy WBD or not, the core business is just too profitable to ignore at this price.
It makes sense. But I do want to circle back to one thing, that 40% market share number.
Yeah, that's the big one.
You framed it as a good thing. Dominance, pricing power. But if this deal goes through, and one company controls 40% of all TV time, surely that just paints a giant target on their back in Washington.
And that is the final provocative thought the report leaves us with. At what point does operational mastery cross the line and become an antitrust nightmare?
Because we've seen this movie before. Standard Oil, Mabel, Microsoft in the 90s.
Exactly. If the Department of Justice looks at that 40% number and decides it's too much power, well, we might look back at these current fears about debt and think they were trivial.
You're saying the real risk isn't that the business fails. The risk is that it becomes too successful.
A forced breakup of the company would be a lot messier than just paying off some debt.
That is a fascinating and slightly terrifying thought to end on. Success brings its own punishment.
It always does.
Well, looking at the numbers, it seems the engine is fine. Even if the passengers are panicking, we'll have to see if the merger actually clears.
Don't forget to like, share, and subscribe for more.